Welcome back to our Futures Options Spread lessons. I'm Joe Follico, Principal Futures Broker at Insignia Futures and Options. This series of videos will be detailing futures options spread strategies I found to be the most effective, so stay with me. In case you missed the first lesson in this video series, I'll put a link in the description below to it. Okay, let's get started. In this lesson on futures option spreads, I'll be explaining the Strangle spread. This was the first futures option spread strategy I utilized when I first started trading futures option. It has served me well over the years. The Strangle spread is best implemented when a market is in a sideways trend. As the name suggests, we will be wrapping around or strangling the current market price action by selling both an out-of-the-money call and an out-of-the-money put in the same contract month. In doing so, we are choosing strike prices that we anticipate the underlying futures prices will not reach in either direction prior to the option's expiration date. Using coffee futures as an example, you can see in this futures chart prices have been moving in a sideways trend for several months. In reviewing the December 2022 futures option strike prices, I would be comfortable selling the 300 calls for 90 points and the 160 puts for 75 points. This will give us a total of 165 points in total collected option premium, or $618.75. Each point in coffee futures and options equals $3.75. The total premium collected when selling futures options is the maximum gross profit, less commissions and any trade fees. I hope you're finding this video informative. Please take a moment to like and subscribe to our futures trading channel if you'd like to see more videos like these. As long as coffee futures prices do not reach either our 300 call strike price or our 160 put strike price prior to the option's expiration date, our total gross profit will be realized at expiration. Of course, you could liquidate either or both options at any time before expiration for whatever the current market value is. One of the benefits I like with the Strangle futures option spread is that if the market were to have a sudden large drop or big rally, I would have less of a loss than if I were not in an option spread. For example, if coffee prices started to rally upwards, we would probably be losing money on the 300 call, but because this is a spread trade, we'd most likely be making money on the 160 put. If this situation were to occur, I would reevaluate the trade to decide if I wanted to liquidate the entire spread, or if I felt an upward trend was starting, I could just liquidate the call and hold on to the put to try to gain more profit and make up for any losses on the call option. Remember, even though this is a spread, there is no fixed amount of risk on a Strangle spread. Proper trade and money management must be used to determine how much money you're willing to risk before entering the trade. Also, always remember to account for commissions and trade fees when calculating your profits and losses. I hope you found this video informative. If you have any questions about using this strategy, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.